Welcome back to The Deep Dive. We're the show that tries to cut through the noise, get straight to the core insights.
That's the goal.
And today, we're unpacking something. Well, it feels like a seismic shift, honestly, right at the heart of the crypto world. Think about this. You've got a newer player, Decentralized, almost like a digital underdog.
Right, relatively speaking.
And they are aggressively, really aggressively challenging a giant, a titan like Binance, whose dominance seemed, well, impenetrable for so long.
Yeah, it seemed almost set in stone.
And not just anywhere, but in derivatives, one of the biggest, highest stakes parts of crypto.
It's a remarkable story unfolding.
Yeah.
And what makes it so compelling, I think, is just the sheer scale of this challenge.
Exactly.
We're not talking about, some small niche competitor nibbling at the edges.
No.
This challenger has surprisingly quickly managed to pull away a really significant percentage of trading volume from a leader that, like you said, looked unshakable until maybe just recently. Yeah, it's a real David versus Goliath thing playing out right now in crypto finance. And for you listening, this story, well, it directly impacts where you might trade, how you think about risk.
Where you might invest.
Absolutely. And how you think about the whole future of finance, really, in this Web3 world that's moving so fast. It makes you rethink trust, tech, market structure, all of it.
And the speed, the velocity, and the sheer size of this shift is what's truly fascinating. So our deep dive today is really focused squarely on Hyperliquid.
Okay.
It's a decentralized perpetuals exchange, and its rise against Binance's, long-held grip on crypto derivatives. It's been remarkable. Sources are calling it explosive growth, almost gravity-defying in a way.
And the numbers. When you actually look at the data, the figures are pretty eye-opening. I mean, I'm almost hard to believe.
Yeah.
Hyperliquid hitting 14% of Binance's derivatives volume ratio. 14%.
That's a huge number in that context.
And just think about the incumbent, right? But it's not just competing. It's also dominating its own space, its niche, capturing, 80% of the decentralized perpetuals market?
80%.
Yeah.
Within that specific DEX Perps category.
That's not just impressive. That's sending a massive signal about where a big chunk of the market seems to be heading.
And that really sets up what we're trying to do today, our mission, if you like.
Right.
We want to explore not just what's happening, Hyperliquid versus Binance, but the why. Why now? Why so intensely?
Yeah, what are the forces?
Exactly. What does it mean for individual traders? Both, the retail folks maybe just getting started and the pros who need top-tier execution.
Okay.
And then the bigger picture, right? What about the whole Web3 ecosystem? Is this just like a blip, a flash in the pan we forget next year?
Or is it something fundamental, a real reshaping of crypto finance?
That's the core question. Is this a lasting change?
And that's why we've waded through, tons of articles, research, market data, trying to distill the key bits for you. Our goal is to give you a clear, informed view, help you grasp the nuances without drowning in all the information out there.
And hopefully spark some thinking about what it means for you.
Exactly. Okay, so let's get into it. The new challenger. Hyperliquid's explosive ascent.
Right. So that growth path, it really has been, unprecedented seems like the right word.
Yeah.
Hitting 14% of Binance's derivatives volume ratio. That's explosive, like you said. You have to remember, for years, Binance wasn't just dominant in derivatives. They were the market in many ways.
They were the benchmark.
Absolutely. Billions in daily volume, huge global user base, deep liquidity. They were the default place for leverage trading for so many people.
So for a new platform, and a decentralized one at that, to carve out 14% of that massive pie.
It means it's not just finding new users. It's actively pulling significant market share away from an established giant. It's a direct challenge.
Okay, but that's a huge claim. Binance's position was so entrenched. What exactly is Hyperliquid doing differently? How are they managing to not just challenge, but actually disrupt things so effectively? What's their secret sauce?
That's the key question, right? And it gets to the heart of their innovation. It's not just that they're decentralized. Lots of protocols try that. It's how they've engineered it.
Okay.
They built this really innovative architecture. It uses an off-chain order book, but critically, settlement happens on-chain.
A hybrid approach.
Exactly. Hybrid approach. And that's kind of the game changer here. It gives you the speed. We're talking sub-millisecond latency. The kind of execution pros and algos need. Performance like a top CEX.
Right.
But, and this is crucial, it still maintains the core DeFi principles.
Yeah.
Self-custody, transparent settlement on the blockchain.
So you get the speed and the security without trusting a third party with your funds.
Precisely.
Yeah.
Best of both worlds, essentially. They seem to have cracked that trade-off.
That sounds like some serious engineering work.
Oh, for sure. And this technical edge, combined with, smart market incentives, capital efficiency, it creates this powerful flywheel.
How so?
Well, they offer competitive fees, they have effective liquidity mining programs, the trading engine's super fast. This attracts the sophisticated players,
Yeah.
right? Market makers, high-volume traders.
Yeah, the big players come in.
Yeah. And their capital deepens the liquidity on the platform. Deeper liquidity means tighter spreads, less slippage, which then attracts more users. Retail, professional, everyone benefits.
It feeds itself. More liquidity attracts more users, which attracts more liquidity.
Exactly. A self-reinforcing cycle.
Huh?
And that's what's allowed them to scale so fast and really redefine what's possible for decentralized derivatives. If you visualized it, a chart of Hyperliquid versus Binance volume,
Yeah.
you'd see Hyperliquid's line shooting upwards aggressively. It's not just slow gains. It's a platform that figured out how to scale and challenge the old guard through real innovation.
It really makes you think, what does it actually take to pull that off in such a tough market? It forces you to consider the underlying forces making this possible. It's clearly not just a slick interface. Something fundamental is different.
And Hyperliquid seems to have found that different.
Right. And that difference stands out even more when you look at their dominance in their own backyard, so to speak, capturing 80% of the decentralized perpetuals market share.
80%. It's staggering. It's not just growth. It's near monopoly within that specific DEX segment. Suggests a really effective model or maybe just a very strong user preference among DeFi natives.
That's a key point, decentralized perpetuals. Maybe we should quickly clarify for listeners, what's the basic difference between CEX perps, like on Binance, and DX perps, like on Hyperliquid? And why is that 80% figure in the DX world so significant?
Good point. So centralized perpetuals, Binance, other big CEXs you're trading on their platform, they hold your crypto.
Custodial.
Exactly. They run the order book, the matching engine, liquidity. It's all inside their system. You're trusting them, that single company, with your money and your trades. If they get hacked, mismanaged, face regulators, your funds could be at risk. We saw that with FTX.
You mean fully clear, yeah.
Decentralized perps, on the other hand, operate directly on a blockchain. Your funds stay in your wallet. Self-custody.
You hold the keys.
You hold the keys. The trading logic, matching, settlement, it's all handled by smart contracts.
Yeah.
Code that runs automatically, transparently, verifiable by anyone on the public ledger.
Okay, so much more transparent, and you keep control.
That's the core idea. So Hyperliquid having 80% of that market, the decentralized perp space, means that among all the DEX options, users are overwhelmingly choosing their model. It makes you wonder about the other DEXs trying to compete. Is this turning into a winner-take-most situation in DeFi perps, where maybe one or two really dominant high-performance players emerge? Kind of like how a few CEXs dominate the centralized world?
It definitely looks like it might be heading that way, at least for now. Consolidation around the best tech and user experience.
The early signs point that way, yeah.
Okay, so Hyperliquid is clearly dominating the DX perp space. But to really feel the weight of this achievement, this whole David versus Goliath story, we need to pause and remember just how incredibly dominant Binance was historically in this market.
Absolutely. You can't overstate it.
Only then can we really appreciate what Hyperliquid is pulling off.
For years, Binance basically was the crypto derivatives market for most people. They didn't just have a lead. They had overwhelming control.
Built on what?
Deep liquidity, first mover advantage in many areas, a massive global user base that was super engaged, and just a huge range of products, spot, futures, options, everything.
Right.
They had a fast, efficient trading engine. Their brand was, for a long time, almost synonymous with crypto trading itself. Research firms like Kaiko consistently showed just how locked in Binance's position was. They were the undisputed champ.
And that's why seeing Hyperliquid not just survive, but thrive and actively siphon off volume, it's more than just noteworthy. It signals a really big shift.
Definitely.
It's not a minor ripple. It feels like a strong current driven by forces that have fundamentally changed what traders want, what they prioritize in a platform.
Yeah.
So to really get Hyperliquid's rise, we have to look at those underlying forces now, dig into why traders, retail, and institutional are making this move.
Exactly. This brings us straight to the why.
Yeah.
What's driving this shift? And like you said, it's not just about a fancy new platform. It feels more fundamental, driven by some big external factors that have really shaken up trust in the crypto's case.
And the core battleground seems to be decentralization versus centralization, right? Sources say traders are actively moving funds from CEXs to DXs. How deep does this run, though? Is it really a systemic shift? Are people abandoning CEXs entirely?
I wouldn't say abandoning entirely. CEXs still have their conveniences, easy fiat ramps, maybe some specific products. But yes, it's absolutely a systemic shift in thinking, a major reevaluation of risk, trust, and who controls your money.
Okay.
And the biggest catalyst, the one everyone points to, was the FTX collapse. That just shattered trader trust in centralized exchanges, maybe irreversibly for some.
Yeah, that was a moment. The abstract idea of counterparty risk suddenly became brutally real for millions. I mean, the thought of a major exchange just imploding, taking user funds with it, felt theoretical until it wasn't.
Exactly. People lost life-changing amounts of money, not because they made bad trades, but because the platform itself was, well, deeply flawed. Mismanagement, commingling funds, lack of transparency, no real audits.
It drove home that lesson. Not your keys, not your crypto. Hard.
It really did. Even sophisticated traders who thought they were diversified got hit hard. The scale of the loss, the opacity, it scarred the market psyche. It shifted the default assumption from, my funds are probably safe on this big exchange, to, my funds are only safe if I control the keys myself.
Trust no one but the code, maybe. And even then, understand the code.
Something like that, yeah. It forced a much more critical perspective.
And then on top of that internal implosion, you have the external pressures. Ongoing regulatory scrutiny hitting even the biggest players, like Binance, right? Cases in the US, the EU.
Yeah, and that adds another layer of uncertainty for traders relying on CEXs.
How so? What are the practical impacts?
Well, regulatory action isn't just headlines. It can mean huge fines for the exchange, maybe for AML KYC failures. It could mean they lose licenses in certain countries, have to delist popular tokens, or suddenly restrict services for users in your region.
So, potential disruption.
Big time. Service interruptions, maybe even temporary asset freezes in some cases, legal uncertainty hanging over the platform. It just makes relying on a single CEX feel riskier, even if it's a giant like Binance. If they're under investigation, you start wondering about their long-term stability. It pushes people to look for alternatives that seem more resilient.
So it's like a perfect storm for CEXs. The FTX trust crisis from within and regulatory heat from without.
Pretty much.
It really forces you as a trader to weigh your priorities. Is it the ease of the CEX, or is it the security, the self-custody, the transparency of a D, which matters more now? These events have definitely pushed that calculation for a lot of people.
And this movement, this shift in trust and where capital is flowing, that leads us to this idea of liquidity migration.
Okay.
The sources pose this big question. If more traders shift, can we see structural changes in where leverage and volume live in crypto? That's not just minor tweaking. It's talking about potentially re-architecting the market itself.
Whoa. Structural changes. That sounds massive. It's not just about where users click to trade, right? It's about where the actual money is, the deep pools of capital that make markets efficient.
Exactly. Liquidity is everything. It's the ability to buy or sell without moving the price too much. When significant liquidity moves, it changes price discovery, it changes spreads, it changes your ability to execute large orders without getting killed by slippage.
Especially for the big players.
For market makers, for institutions, deep liquidity is absolutely critical. So if a big chunk of that capital, that trading volume, physically moves from CEXs to DELX, it fundamentally alters the power dynamic between them.
How could that play out?
Well, you could see a future where DELX would become the primary venues for certain trading, especially derivatives. That would be a radical shift. Market makers would dedicate more capital to DXs, creating that positive feedback loop we talked about. You might see more decentralized price feeds gain prominence, reducing the influence of a few CEXs on global crypto prices. Imagine the deepest order books for Bitcoin perps being on-chain, run by code, not a corporation.
That would be a profound change, affecting everything from arbitrage to the cost of leverage itself.
A huge structural shift.
And we're seeing signs of this already, right? Sources mention DX versus CEX Perps market share analysis, showing DXs are genuinely penetrating this traditionally centralized area.
Absolutely. It's not just a theoretical possibility anymore. The data shows DX Perps gaining ground, attracting real volume. It shows growing comfort, growing trust in this decentralized infrastructure for complex finance, not just holding tokens.
Moving beyond DeFi summer stuff to serious trading.
Exactly. The fact that DX perp market share is growing, even with giants like Binance still around, says a lot about the tech maturing and where user preferences are shifting.
Okay, so let's focus on the impact. Who does this affect and how? Let's start with the individual trader, both retail and the pros. For retail, the big takeaway seems to be more options, more transparency, and self-custody.
Which is massive for the average person. Self-custody, like we said, means you control your assets cryptographically.
Yeah.
Your funds aren't sitting on an exchange's balance sheet, vulnerable if they mess up.
Right. Reduces that counterparty risk. FTX drove that home.
Brutally. If you don't hold the keys, it's not really your crypto. Self-custody eliminates that specific risk.
And the transparency aspect.
Huge benefit, too. On a DEX, transactions are typically on-chain. Anyone can look them up on a block explorer. There are no hidden practices, no opaque internal ledgers. You can often see the protocol's health, its reserves, its liquidations. It's all out there, auditable.
So for you listening as a retail trader, how does that change things? Self-custody means your security, your control. It shifts trust from a company to verifiable code. You're trusting math, not a CEO.
It's a fundamental shift in the trust model.
Now, what about the pros? The analysis suggests Hyperliquid's performance liquidity depth, speed might now rival or even beat CEX's. That's huge for them.
It's critical. Professional traders, especially high-frequency firms, quants. They live and die by execution quality.
Slippage, order book depth, speed, milliseconds matter, basis points matter.
Absolutely. Tiny differences in execution price on large trades make or break profitability. If Hyperliquid is consistently delivering low slippage, deep order books, and near-instant execution, that's a game changer.
How do we know that, though?
Well, sources point to things like liquidity depth charts, comparing spreads and slippage across platforms. These detailed analyses show Hyperliquid offering really tight spreads, significant depth on the order book, and super fast execution.
Good enough for the pros.
Apparently, yes.
Yeah.
Good enough that institutional players, prop trading firms, algo strategies, they're finding this DEX infrastructure capable of meeting their intense demands. That's a massive vote of confidence. It signals DeFi isn't just for retail anymore. It's ready for serious professional capital.
Okay, so major benefits. But let's talk risks. Nothing's perfect. Decentralization brings its own set of challenges. Sources highlight smart contract vulnerabilities, liquidation mechanics, and liquidity fragmentation.
Vital points. Everyone using DEXs needs to understand these. Smart contract risk is inherent. It's the risk of bugs, exploits, or just unforeseen issues in the platform's code.
Code is law, but code can have flaws.
Exactly. Even with multiple audits, which good protocols always have, vulnerabilities can exist. Things like reentrancy bugs, logic errors, oracle manipulation risks. They could lead to loss of funds or system problems. It's a different type of risk than CEX risk, which is more about the operator's actions or failures. DEX risk is often about the code itself.
Okay, and liquidation mechanics. How are they different or riskier on DXs compared to the polished engines on CEXs?
CEXs usually have sophisticated internal liquidation engines, fast, efficient, often using internal capital buffers. DEX liquidations are different. They're usually triggered by external liquidator bots.
Bots watching the chain.
Yeah, monitoring for positions falling below margin requirements. It's transparent, coded in the smart contracts, but it relies heavily on accurate, real-time price data from oracles.
Ah, the oracle problem.
Right. If those price feeds are wrong, delayed, or manipulated, or if the underlying blockchain gets super congested, think high gas fees. Liquidations might not happen on time.
What happens then?
Positions could go deep underwater, creating bad debt for the protocol. Or you could get cascading liquidations if the system gets stressed. It's a different setup, relying on external data and network performance in a way CEXs don't. Requires understanding from the trader.
Got it. And the last one, liquidity fragmentation. If liquidity is spread across tons of DXs, doesn't that make things less efficient?
It can, yeah. If the total money available for trading a specific pair is scattered across many small DXs, putting in a large order on any single one might cause a lot of slippage. The price moves against you because there isn't enough depth right there.
So harder for big trades.
Potentially, yeah. You might have to split orders across platforms, which adds complexity and cost. However, the fact that Hyperliquid has grabbed 80% of the DX perp market actually helps mitigate this risk, at least within their ecosystem.
Because they're consolidating the liquidity.
Exactly. They seem to be creating a deep, unified pool for their users. But it's definitely dynamic to watch as the overall DeFi space evolves. Will liquidity concentrate or fragment further?
So it's a balancing act for users. For you listening, how do these DX risks Smart contracts, liquidations, potential fragmentation weigh against the benefits like self-custody and transparency. Is that trade-off worth it for you? That personal risk assessment is driving these market flows.
In this whole shift, it's not just about traders. It impacts the entire Web3 ecosystem. It really signals, I think, the maturation of DeFi.
Oh, so.
The fact that DXs like Hyperliquid are gaining serious traction in a demanding area like derivatives, it validates the underlying DeFi infrastructure. It proves it's ready for serious high-stakes trading.
That is huge. It's not just one platform's win. It's a testament to the tech itself. The blockchains, the protocols, the smart contracts. It shows DeFi can handle the complexity, the speed, the security needed for institutional-grade stuff.
Right. It moves DeFi beyond those early, maybe more experimental phases. If you look at the aggregate data DeFlama, Glassnode tracking, overall DeFi volume, total value locked, TVL, you see this trend of growth and increasing sophistication.
Yeah.
Hyperliquid, succeeding with Perps, shows the infrastructure scalability, oracles, security is robust enough for this high-frequency, high-stakes activity.
Yeah.
That was a big question mark before. Now it seems less so. It's a proven financial primitive working at scale.
And that validation, that proof it works, could that spark even more innovation? New derivatives beyond just perpetuals, like options, structured products, maybe yield-based leverage, all built on chain.
That feels like the natural next step. It's incredibly exciting, actually. Success in one complex area like Perps builds confidence. It attracts investment, talent, developers, encouraging them to tackle even more complex financial instruments on-chain.
Rebuilding TradFi tools, but decentralized.
Rebuilding and maybe even improving. Imagine things like exotic options, interest rate swaps, but with the DeFi benefits: transparency, global access, permissionless nature. This validation lowers the barriers, encourages engineers to build things previously only possible in traditional finance.
So, thinking ahead, what new tools could you see emerging in DeFi that maybe only exist in TradFi today? It really opens up possibilities for managing risk and capital.
And this whole movement, it really shows DeFi growing up, moving beyond, the early yield farm era.
High APYs, token swaps.
Right. Moving from that to genuinely creating Wall Street-level products, but doing it on-chain.
It's a definite contrast. Early DeFi felt simpler, maybe more speculative in some ways. Now we're seeing complex financial engineering, sophisticated risk models, collateral systems, advanced trading mechanics being built out decentrally.
Improving on TradFi in some cases with transparency and efficiency. We've gone way beyond just lending and borrowing now.
Yeah. And look at the evolution within DX Perps themselves. DYDX was the leader for a long time, right?
Absolutely. They pioneered a lot, showed an order book model could work decentrally at scale. They set the standard.
But now Hyperliquid has overtaken them in that specific niche.
Which shows how dynamic this space is. It's not static. Innovation drives leadership. It pushes the boundaries of what DeFi can do. It's constant evolution.
And it wasn't just DYDX. Sources also mentioned GMX growing significantly in 2022-23.
Right. GMX, with its different model, the VAMM, and pooled liquidity. They also proved there was huge demand for DX Perps, laying some important groundwork. Showed it wasn't just a tiny niche.
So it's a pattern. Multiple successful DX Perp protocols emerging, suggesting a real market shift, not just one lucky platform.
Exactly. And to track this success properly, we need to look at the right metrics. Go beyond just the headlines.
Okay, like user growth data, active addresses, daily transactions, TVL, and Hyperliquid. Why are these important? How do they paint a picture?
They each tell a different part of the story. Active addresses show how many unique wallets are using the platform. Daily transactions show how often they're using it. Together, they indicate real engagement and adoption. Is it broad-based? Are people sticking around?
TVL, total value locked.
TVL shows the total amount of assets locked in the protocol's contracts. For a derivatives exchange, that's closely tied to liquidity. High TVL usually means deep liquidity, which means better trading, less slippage.
So you need all three.
Yeah, looking at them together gives a much better picture. High TVL but few users might mean a few whales dominate. Lots of users, but low TVL might mean lots of small, maybe less committed traders. You want to see healthy growth across the board. It signals confidence and real usage.
Got it. And then there are things like funding rates and open interest, OI, comparing those between, say, Binance and Hyperliquid. What does that tell us?
That gives you insight into market sentiment and leverage. Funding rates show whether longs or shorts are paying more to hold positions, basically. Is the market leaning bullish or bearish on that platform?
Positive funding equals bullish, negative equals bearish, generally.
Generally, yeah. And open interest OI is the total value of all open contracts.
Hmm.
Not volume, but the total number of active bets. High or growing OI means lots of activity, strong participation, deeper liquidity, and maybe more conviction from traders.
So comparing OI and funding rates between Binance and Hyperliquid.
Tells you not just where volume is moving, but where traders are actually positioning themselves. Where is the leverage building up? What's the sentiment like in each venue? If Hyperliquid's OI is growing strongly along with its volume, especially in volatile times, it suggests a real shift in speculative capital and trust. It's a much richer signal than just volume alone.
That's super insightful. It shows how you, listening, can use these more advanced metrics to really evaluate the health, sentiment, and potential of these platforms. Look beyond the surface numbers.
Exactly. Empower yourself with the data.
Okay, so let's try and wrap this up, synthesize what we've covered in this deep dive. We've seen Hyperliquid's really impressive rise, directly challenging Binance's long reign in derivatives.
A major feat.
We've explored the deep forces driving at the big push towards decentralization, fueled by things like the FTX disaster and ongoing regulatory pressures on CEXs.
Shifting the landscape of trust.
And we've seen this isn't just about market share. It reflects evolving priorities, trust, control, transparency, and amazing technological progress. It really signals DeFi is, well, maturing, growing up.
It's a powerful story of innovation meeting a clear market demand for something different, something better in terms of user control and transparency, and it's fundamentally changing crypto finance.
Which leaves us with a big provocative thought to mull over. Is this really the beginning of the end for CEX dominance, at least in areas like derivatives? Is DeFi starting to truly eat the centralized world's lunch?
Or maybe asked differently,
Yeah.
if more and more traders keep moving their capital, their leverage, to DX Perps like Hyperliquid, what actually happens to Binance's grip? What happens to other CEXs who've relied on holding customer funds for so long?
That's the question. We really encourage you to think about the long-term ripples of this shift for the whole financial landscape and for how you participate in it.
It's a story that's far from over, with huge consequences still unfolding.
Yeah.
Its impact on the future of finance could be immense.
Absolutely. Well, thanks for joining us on this deep dive.
Thank you.
We'll see you next time.